Hello everyone, my name is Murtaza Quaid and in today's session we will be discussing an important accounting standard IAS 24 which focuses on providing disclosures related to transaction with related parties. So, why do we need to provide these disclosures? The main idea behind this is to address the potential risk associated with transactions that happen with person or entities related to the business. These related party transactions carry a risk of being conducted on a non-arm's length basis. Sir, what do you mean by non-arm's length basis? A non-arm's length basis means any transaction which is not on arm's length basis. Sir, then what do you mean by an arm's length basis or an arm's length transaction? Okay, an arm's length transaction is any transaction that occurs under market terms at a fair value. In other words, it is a transaction where the parties involved act independently and have no relationship to each other, ensuring that the terms are fair and reflect market condition. IAS 24 emphasizes that in a business scenario where related party relationship exists, there is a risk that transaction may occur on a non-arm's length basis, and this can potentially lead to dilution or adverse effect on the money of investors and the shareholders. To mitigate this risk, the standard requires entities to provide disclosures about these related party transactions. The objective of IAS 24 is to ensure transparency and fairness in financial reporting, protecting the interest of investors and shareholders by providing them with information about any related party relationships, about any related party transactions. In our session, we will further define what constitutes a related party and explore the types of disclosure that are required under IAS 24. Now, let's address an important question. What if there is a transaction with a related party and we have sufficient and appropriate evidence that this transaction happened on arm's length basis, meaning thereby it was conducted fairly and at market terms? Do we still need to provide a disclosure? Do we still need to disclose these facts to the users and the stakeholders of the financial statements? The answer is yes. According to IAS 24, even if a transaction with a related party occurs on arm's length basis, we still need to provide the necessary disclosures. The objective of IAS 24 is to ensure that the users of the financial statements are aware of the existence of related party relationship and how these relationship might affect the financial affairs of the company. Providing these disclosure is a prudent approach because transaction with related parties as well as any outstanding balances or commitments can impact the entity either in the short term or in the long term. Therefore, it is important to disclose these details to maintain transparency and fairness in the financial reporting. IAS 24 has two main aspects. Number one, identifying related parties, understanding who qualifies as a related party. And number two, reporting transactions, how to disclose transactions that have occurred with these related parties. By addressing these two aspects, IAS 24 aims to provide a comprehensive framework for related party disclosures, ensuring that stakeholders have all the necessary information to assess the impact of related party relationships on the entity's financial position and the entity's financial performance. Let's start with an understanding what constitutes a related party under IAS 24. A related party can be either a person or an entity that is related to the reporting entity. First, we need to understand what a reporting entity is. A reporting entity is the entity for which we are preparing the financial statements. In this context, We are the reporting party. We are the reporting entity. A person or any entity can be considered a related party if they meet the certain criteria. Not all persons are related parties to the entity. Only those who fit specific definitions provided by IAS 24. We will break down the types of person who can be related parties to the reporting entity. According to IAS 24, a person or a close family member of that person is considered a related party to the reporting entity if they fall into any of the following three categories. First of all, a person who controls or jointly controls the reporting entity. For example, if there is a person who is a major shareholder and either alone or together with someone else controls the reporting entity, they are related party. Any transaction with this major shareholder or the controlling party need to be disclosed. Secondly, a person who has significant influence over the reporting entity. Significant influence is defined as the power to participate in the financial and operating policies of the entity. Even if this person does not have control, their ability to influence decisions makes them a related party. This definition is allied with what we have studied under IAS 28. And the third one is a person who is a key management personnel of the reporting entity. Key management positions can include roles such as Chief Executive Officer, Chief Financial Officer, that is CFO, Head of Supply Chain, Head of Marketing, Head of Sales, Head of Finance. Any person holding a significant position in the business is considered key management person and is a related party. And any transaction with a key management personnel must be disclosed. By identifying these related parties, we ensure that all relevant transactions are disclosed, providing transparency and clarity in our financial statement. Now, according to IAS 24, not only do certain individuals qualify as related parties, but their close family members do as well. So what is the definition of close family members? IAS 24 defines close family members as those individuals who can influence or be influenced by the person who controls, jointly controls, has significant influence over, or is a key management personnel, that is KMP of the reporting entity. In other words, any family member who can influence or be influenced by a related party is also considered a related party. Close family members typically include your children, your spouse or domestic partner, your spouse or domestic partner's children, your dependents, your extended family such as uncle, aunt or other relatives who can influence or be influenced by you. These close family members are always within the definition of related parties. Any transactions, any outstanding balances or any commitments involving these individuals must be disclosed in the financial statements. Additionally, some entities can also become related parties. According to IAS 24, any entity that is part of the same group as the reporting entity is considered a related party. This means that all members of the same group are related to each other. For example, if there is a parent company and it has a subsidiary, both the parent and the subsidiaries are related parties. If the subsidiary has further subsidiaries S1 and S2, all these entities are part of the same group and are related parties to each other. In short, all entities within the same group are considered as related parties to each other. This ensures that any intra-group transactions are properly disclosed, maintaining transparency and clarity in the financial reporting. Moving on, let's discuss the inclusion of associates and joint ventures as related parties. According to IAS 24, Not only subsidiaries, but also associates and joint ventures are considered related parties. This applies to the reporting entity and any entities within the same group. For example, if there is a parent company that has an associate, that associate is a related party. If there is a joint venture of the reporting entity or any company within the same group, it is also a related party. If a subsidiary of a parent company has an associate or a joint venture, those entities are related parties as well. This means that all associates and joint ventures of the reporting entities as well as those of any entities within the same group are considered as related parties. Let's say there is a parent company and this parent company has a subsidiary. This subsidiary has its own associate. According to IAS 24, this associate is a related party to the parent company because it is an associate of a company within the same group. Additionally, IAS 24 extends its definition further. If one entity is a joint venture of a third entity and another entity is an associate of that same third party, both are considered related parties. For example, if ABC company has an associate and a joint venture, both the associate and the joint venture are related parties to each other and to the ABC company as well. In short, the definition of related parties under IAS 24 includes subsidiaries, associates, joint ventures, entities that are associate or joint ventures of any company within the same group, and entities that are joint ventures or associates of the same third party. Understanding these relationships helps ensure that all relevant transactions are disclosed, maintaining transparency in the financial reporting. Under IAS 19, we studied that entities often form separate corporate legal structures to manage post-employment benefits for their employees. If there is a company that has established a separate entity to manage gratuity funds or provident funds for its employees, this post-employment benefit company is also considered a related party. It makes sense because the reporting entity funds this post-employment benefit company and therefore it should be recognized as a related party. Furthermore, if there is any entity controlled by the person identified as a related party under IAS 24, it is also considered a related party. Remember, IAS 24, a related party is anyone who has control, joint control, significant influence, or is a key management personnel, KMP of the reporting entity as well as their close family members. If any of these individuals have a separate entity, that entity also becomes a related party. Let me give you an example to illustrate this point. Suppose you are a company called IQ company and you have a head of supply chain who is a key management person. Now, as an example, the wife of the head of supply chain owns another entity which sells steel in the market. While there is nothing wrong with that head of supply chain's wife owning a separate business, but if IQ company transacts with that steel selling entity, it becomes a related party transaction. Why? Because the entity is controlled or jointly controlled by a person who is a key management personnel or by a close family member of the key management personnel. So any entity that is controlled, jointly controlled, or significantly influenced by a person previously identified as a related party becomes a related party for the reporting entity. This ensures that all transactions with such closely related entities are conducted on a fair basis, ideally at arm's length, and are reported to the shareholder if they are not. Another example is management companies. Management companies are those whose job is to manage different investments of the ultimate parent company. If a company is being managed by a management company, that management company is also a related party. In summary, we have discussed various type of entities and individuals that forms part of the related party definition. Always remember the type of persons and the entities that can become related party for your entity to ensure comprehensive and transparent financial reporting. Now, moving forward, while IAS 24 defines the type of persons and entities that are considered related parties to the reporting entity, it also specifies which parties are never considered related parties. For example, if there are two entities that share a common director, this alone does not make them related parties. Suppose you have a non-executive director on your board of directors who is also a non-executive director in another company. These two companies do not become related parties simply because they share one common board member. This is because non-executive directors typically do not have significant influence over the entities, ensuring that their decision remains independent. Similarly, other entities and individuals that typically engage with the business on an arm's length basis are also not considered related parties. This includes provider of finance, trade unions, customers, franchisors, distributors, retailers. These parties generally engage with the business under standard market condition, ensuring fair and independent transaction. As a result, they are not classified as related party even though they frequently transact with the reporting entity. It is important to note that while these parties often engage in business transactions, it is less likely that these transactions occur on a non-arm's length basis. Therefore, they are always termed as unrelated parties. By understanding which parties are and are not considered related parties, we can ensure accurate and transparent financial reporting. The next part of understanding IAS 24 involves the disclosure requirements. The first type of disclosure that any reporting entity must provide is a relationship disclosure. This disclosure outlines information about who your parent company is or who your subsidiaries are. Essentially, it provides detail about your close equity relationships. You need to disclose the identity of your parent company or the ultimate parent company as well as any other significant relationships. For related party transactions, there are four key pieces of information that must be disclosed. Number one is the nature of relationship. You need to clearly define the nature of relationship with the related party. For example, if a company is a subsidiary, specify this relationship. Number two, transaction information. You need to provide details about the transactions that occurred with the related party during the reporting period. This includes transactions such as sales, purchases, and other exchanges. Number three is the outstanding balances. You need to disclose any outstanding balances with the related party as of the reporting date. This could include receivables or payables. And number four, irrecoverable or doubtful debt. You also need to specifically disclose if there have been any irrecoverable or doubtful debt related to the transaction with the related party. This is done to ensure prudence and transparency. IAS 24 requires a separate disclosure for the key management personnels. Key management personnels are individuals responsible for running the company, such as directors and the chief executive officer. They have fiduciary duty to act in the best interest of the entity. Often, KMPs, key management persons, are in positions where they can influence or set their own remuneration. Therefore, IAS 24 mandates that any remuneration paid to the key management persons must be disclosed separately. This disclosure should include short-term employee benefits, that is salaries, bonuses and other short-term benefits. Long-term employee benefits, that is pension schemes and other long-term benefits. Post-employment benefits, that is retirement benefits such as pension, and termination benefits, that is compensation paid upon the termination of employments, as well as share-based payments, any equity compensation such as stock option. The objective of these disclosure is to provide transparency so that shareholders are fully informed about what is being paid to the directors and the key management personnel of the company. As we come towards the end of our discussion on IAS 24, it is important to note a particular exemption provided for government-related entities. In some cases, the controlling party of an entity is the government. For instance, imagine you are a national airline controlled by the government of US, and the government of US may have control over 2000 other entities used to run the country, some of which might be of sensitive nature and cannot be disclosed to the public. If IAS 24 did not provide this exemption, companies would be required to disclose all relationship with these 2000 government entities, including those that are sensitive and cannot be publicly disclosed. This requirement would not be practical in real life. Therefore, IAS 24 provides an exemption for government-related entities. Entities that have a government relationship only need to provide a brief disclosure about their relationship with the government. For other government entities, no specific detailed disclosure is required. Here are the required disclosures for a government-related entities. Number 1, name of the government. You need to identify the name of the government controlling the entity. Number 2, nature of the relationship. You have to describe the nature of the relationship with the government, such as whether the entity is a subsidiary or an associate of the government. Number 3 is significant transactions. You need to disclose any individually significant transactions with the government-related entities. And you also need to disclose any collectively significant transactions with government-related entities. This brief disclosure ensures transparency without compromising sensitive information. That's it for IAS 24. I hope you found this discussion informative. Please make sure to provide me with your feedback. Thank you and goodbye.